I want to start with a simple but critical point. The words we use shape the way we think. The terms shares and stocks may seem interchangeable, but clarifying their difference is foundational for anyone who aims to think like an investor rather than react like a speculator. Principles-based clarity means starting from the foundation rather than from the surface. When people talk about financial markets, about companies, about shares and stocks, the conversation often drifts into jargon or habit. Words get tossed around loosely, and the meaning begins to blur. That's where mistakes and misunderstandings are born. The antidote is not memorizing more definitions, but developing a principle-centered way of thinking where clarity grows out of logic and structure rather than custom. At its core, a principle is simply a timeless truth or a consistent way reality operates. If you align yourself with principles, you gain perspective and clarity even when the situation looks complicated. In finance, one of the clearest principles is ownership. Owning a part of a company means having a claim on its future earnings, its risks, and its value. That is the essence. From this principle of ownership, distinctions like stock and share emerge naturally. A stock is the concept of that ownership in a business or multiple businesses. A share is a divisible unit of that stock. The principle explains the structure, and the words are tools to point to it. Without such clarity, it's easy for beginners to get caught up in the noise of markets. They may buy into a trend without fully knowing what they own, or repeat phrases like "I'm in the stock market," without stopping to ask, what exactly do I mean by stock? Am I talking about a broad class of equities, or am I referring to specific shares of a particular company? This kind of fuzziness seems small, but it accumulates. Small misunderstandings pile into bigger errors, and soon the investor finds themselves making decisions without really knowing the game they're playing. That's why the discipline of returning to principles is so powerful. Clarity through principles also reduces emotional confusion. Markets swing, prices rise and fall, commentators shout their opinions, but if you've taken the time to anchor yourself in fundamental truths, you are less shaken. When you know, for example, that buying a share means literally owning a sliver of the company and its outcomes, then a drop in price doesn't just look like chaos. It looks like the market adjusting its perception of that company's future cash flows. Your decision then becomes grounded. Do I believe this ownership is worth more than the market thinks, or less? The noise fades and clarity takes its place. This approach carries beyond finance. In any domain where decisions matter, those who rely on appearances, habits, or passing trends often lose their way. Those who return again and again to underlying principles cut through the fog. The principle-based thinker is not someone who knows every answer ahead of time, but someone who knows how to orient themselves when faced with a question. When the path is unclear, they don't ask, "What do people usually say?" They ask, "What is the principle here? What does reality itself dictate?" That difference in approach produces clarity. In the context of investing, this kind of clarity enables you to build sound strategies. If you begin with the principle that risk and reward are inseparable, then every investment choice will be filtered through that lens. If you hold to the principle that diversification reduces risk without necessarily sacrificing return, then you won't be tempted by the illusion of safety in a single company or sector. These aren't abstract lessons. They are practical tools that shape every portfolio decision, and they all come from starting with principles, not just with terminology. Principles-based clarity also means distinguishing between the essential and the incidental. Whether one says shares or stocks in casual conversation is incidental. What matters is whether the underlying concept of ownership is clearly understood. Once the essence is grasped, the language can be handled with precision. This is not about being pedantic. It's about making sure that thought and action are aligned. When someone says, I own stocks, the principle-based thinker silently translates that into, this person owns equity stakes in one or more companies. That translation is automatic because clarity is already established. Ultimately, principles-based clarity is not just about communication but about decision making. Every investor will face uncertainty. Every investor will confront the moment when the market seems irrational or when advice from others is contradictory. In those moments, it is tempting to follow the crowd or to act impulsively. But the investor who has built clarity on principles doesn't get lost. They return to first principles: ownership, risk, reward, value. And from there, they know how to move forward. That clarity doesn't guarantee success, but it provides the best foundation for it. To live and invest without principles is like sailing without a compass. You may drift for a while, sometimes even in the right direction, but sooner or later you will find yourself lost. To live and invest with principles is to have orientation at all times. That orientation is clarity, and clarity is power. When trying to understand financial concepts, it is useful to step back and look at how language has shaped them through history. Words are not neutral. They evolve from traditions, cultures, and practical needs of people over time. This is especially true in finance, where terms like shares and stocks have been used differently in various places and eras, and that usage reflects deeper historical and linguistic patterns. By exploring this background, what at first seems like a small semantic difference becomes a window into how societies think about ownership, trade, and investment. The word stock historically traces back to the idea of a store or supply, something held in reserve. In Old English, stock referred to a trunk or a foundation. Over time, the term evolved to mean a supply of goods, and eventually it was used to describe the capital or resources that a business had in store. When people said stock, they were talking about the overall pool of resources or ownership units that a company had available. From there, stock became a broad umbrella for corporate equity in general. Saying I own stock essentially meant I own a piece of the supply of ownership in that business. On the other hand, share comes from the idea of division. To share something is to divide it into parts and allocate those parts to different participants. In finance, a share represents one of those divisions in the stock of a company. If a company's stock is its total equity, a share is the individual slice that can be owned, bought, or sold. The distinction is subtle but important. Stock is the collective whole, while shares are the discrete parts. Linguistically, this reflects a fundamental human pract, staking something that exists in common and breaking it down so individuals can claim their portion. Different regions preserved and emphasized these words differently. In American English, stocks became the dominant everyday term. People say the stock market rather than the share market. The language reflects the focus on the broader concept of equity ownership, often across many companies, rather than on the individual units. In contrast, in British English and other Commonwealth countries, the term shares became more common. People speak of owning shares in a company and of the share market. This reflects a cultural habit of emphasizing the specific, the individual piece of ownership rather than the abstract collective. Both traditions are correct within their contexts, but understanding the linguistic history clarifies why the same thing can sound different depending on where you are. This difference in terms is not just cosmetic. It reveals how people relate to investing. When someone talks about stocks, they are often thinking in categories: technology stocks, energy stocks, growth stocks. Language makes it natural to group and generalize. When someone talks about shares, they are often thinking in particulars. I own 1 100 shares of this company, 50 of that one. The language invites a more precise view. Neither is superior, but being aware of the distinction allows for more accurate thinking. Financial history also shows that language evolves alongside institutions. The first stock exchanges, like Amsterdam in the early 1600s, dealt with shares of the Dutch East India Company. Investors literally owned pieces of voyages, cargoes, and profits. The language of shares was tangible. Ownership was measured in slips of paper representing fractions of ventures. As capital markets grew, the abstraction of stocks took hold. It became less about owning a percentage of a ship's journey and more about participating in the larger pool of corporate equity. The word stock matched the growing scale and abstraction of finance. Even today, the tension between the words reflects the tension between the individual and the collective. Shares remind us that ownership is specific, divisible, and accountable. Stocks remind us that ownership is also collective, pooled, and systemic. Both perspectives are true, and both are necessary. Understanding the historical and linguistic context means realizing that language has shaped how investors think, and continues to shape it. Clarity comes when we don't get trapped in the surface level of words, but use their history to guide our understanding. Knowing that stock once meant a store of resources helps us see why the term is so expansive today. Knowing that share has always meant a portion of something larger reminds us to stay grounded in the specific. This perspective protects against confusion and helps align thought with reality. History and language are not trivia, they are tools. If one ignores them, financial terms risk becoming empty labels. If one understands them, those terms carry the weight of centuries of practice and meaning. By grounding our understanding in historical and linguistic context, we give ourselves not just definitions, but depth. That depth sharpens thinking, and sharp thinking is one of the most valuable assets an investor can have. Independent thinking and caution form the backbone of sound decision making in investing and in life. The temptation to follow crowd is strong, especially when markets are buzzing with excitement or panic. People naturally want the comfort of moving with the herd, believing that safety lies in numbers. But in reality, the crowd is often wrong, and following it blindly can lead to costly mistakes. Independent thinking requires stepping back, questioning assumptions, and developing your own conclusions based on logic, evidence, and principles rather than on what everyone else is doing. Caution adds the protective layer that prevents bold ideas from turning into reckless actions. Together, these qualities balance each other. Independence keeps you from being swept away by consensus, while caution prevents overconfidence from clouding judgment. The world of investing is filled with examples of people who lost fortunes because they failed to think independently. Consider the bubbles that have repeated throughout history, from tulip mania to the dot-com boom to housing markets. Each time, the majority convinced themselves that this time is different, and that prices would keep rising forever. Each time, those who failed to question the prevailing wisdom suffered when reality reasserted itself. Independent thinkers who stepped back to examine the fundamentals often saw the dangers earlier. They asked, what is this asset really worth? Are expectations grounded in reality or in hype? They may not have timed everything perfectly, but their willingness to stand apart from the crowd gave them an edge. Caution works hand in hand with independence because thinking differently can be dangerous if it isn't grounded in humility. It is easy to say, I won't follow the crowd, but without careful analysis and an appreciation of risks, independence can become arrogance. Caution is the counterweight that keeps independent thinking disciplined. A cautious investor does not assume that being contrarian is automatically right. They test their assumptions, they stress test their ideas, and they prepare for the possibility that they could be wrong. This balance creates resilience. For beginners, cultivating independent thinking starts with asking simple but powerful questions. When someone recommends a stock, instead of accepting it at face value, ask, why do they believe this? What assumptions are behind that belief? What do I know and what do I not know? By digging into reasoning rather than just the conclusion, you begin to build the habit of independent thought. Over time, this habit becomes a kind of second nature. You learn to pause before acting, to analyze before agreeing, and to value your own judgment as much as others. Caution, meanwhile, requires awareness of risk. Every investment has two sides, the potential for reward and the potential for loss. Cautious investors constantly measure both. They don't avoid risk entirely because no progress can be made without some exposure, but they manage it carefully. They diversify, they avoid putting all their capital into one idea, and they make sure that a single mistake cannot destroy them. Caution is not fear, it is respect for reality. It acknowledges that no one has perfect foresight and that protecting oneself from the unknown is essential. Independent thinking also means resisting pressure of narratives. Financial media, analysts, and even friends and family create constant streams of opinion. These voices can be persuasive, especially when repeated often, but independent thinkers don't confuse repetition with truth. They examine data, they look at multiple perspectives, and they remind themselves that the loudest voice is not always the wisest. They know that clarity rarely comes from the noise of consensus. It comes from careful, quiet reasoning. History shows that many of the greatest opportunities were seized by those willing to think differently, but who also carried the discipline of caution. Buying assets during times of fear requires independence, because most people are running away, but it also requires caution, because not everything that has fallen in price is worth buying. Selling during times of euphoria also demands independence, because most people are piling in, but caution ensures that you don't sell everything too early or miss genuine long-term value. The interplay of these two traits is what creates sustainable success. In everyday life, the lesson is the same. Independent thinking prevents you from living someone else's script. Caution prevents you from destroying yourself in the process of writing your own. Together, they encourage curiosity, humility, and responsibility. They remind us that reality doesn't bend to popular opinion and that survival often matters more than brilliance. Ultimately, independent thinking and caution are less about cleverness than about discipline. It takes discipline to pause when everyone else is rushing forward, and it takes discipline to admit what you don't know. But that discipline is what separates sustainable success from fragile luck. By cultivating independence without arrogance and caution without paralysis, you create the conditions for clear decisions, resilient strategies, and steady progress in a world full of noise and uncertainty. Looking at markets through a macro perspective means stepping back from the individual tree to see the entire forest. Often, investors focus only on a single company, a single trade, or a single price movement without recognizing that every asset exists within a larger system. That system is interconnected, influenced by countless forces, economic cycles, interest rates, inflation, trade flows, technological shifts, even human psychology. Understanding correlation within that system is essential because no investment exists in isolation. What happens in one corner of the economy inevitably ripples through to another. Seeing those connections gives depth, balance, and resilience to the way you think and invest. At the heart of a macro perspective is the recognition that economies move in patterns, much like a machine. The flow of money, credit, and goods drives cycles of expansion and contraction. When credit is cheap and abundant, companies and consumers borrow more, fueling growth. When credit tightens, spending slows and growth contracts. These patterns repeat across history, creating waves that shape markets on a grand scale. By watching the machine as a whole, rather than just the gears in front of you, you gain the ability to anticipate risks and opportunities before they fully materialize in individual stocks or shares. Correlation plays a crucial role here. Assets that appear independent often move together when underlying forces shift. For example, stocks across different industries may fall simultaneously during a global liquidity crunch, not because each company suddenly became weaker, but because the broader environment changed. Similarly, government bonds may rise when equities fall, reflecting a flight to safety. Recognizing these correlations allows an investor to avoid false diversification. Holding many different stocks may look diversified on surface, but if they all move in the same direction when trouble hits, then the portfolio is more vulnerable than it appears. True diversification is built on uncorrelated return streams, investments that don't all react the same way to the same events. To achieve this, one must think beyond individual picks and consider the broader system. Commodities, currencies, real estate, and bonds each respond differently to forces like inflation or monetary policy. By weaving together exposures that are not closely correlated, an investor can create a portfolio that is resilient under different scenarios. This is where macro perspective directly informs practical strategy. It moves thinking from isolated bets to balanced systems. History demonstrates that ignoring correlation leads to painful lessons. In times of crisis, assets that seemed unrelated often fall together, revealing hidden linkages. During the 2008 financial crisis, investors who thought they were safe because they owned different types of equities quickly learned that everything tied to credit markets was deeply connected. On the other hand, those who had looked at the macro picture saw how excessive leverage across the system created fragility. They understood that once housing began to crumble, the correlations would expand outward to banks, equities, and even global trade. Their broader perspective allowed them to see not just the domino in front of them, but the entire chain. Correlation also works in positive ways. A rise in global demand for technology can lift multiple sectors at once: hardware, software, logistics, energy. Understanding these positive correlations allows investors to capture broad themes rather than just isolated companies. In this way, macro thinking isn't just about defense, it's also about offense, recognizing when different parts of the system will reinforce each other and create powerful waves of growth. The importance of this perspective goes beyond investing. It teaches a way of thinking about reality itself. Nothing stands entirely alone. Every decision, every outcome, every movement is connected to others, often in ways not immediately visible. To live effectively, one must learn to map these relationships. Correlation becomes not just a mathematical statistic, but a way of perceiving patterns in life. When one area is under pressure, another may be buoyed, and balance is found by understanding those shifts. Adopting a macro perspective requires humility. The system is vast, and no one can know every detail. But by training yourself to look for patterns, relationships, and correlations, you can reduce blind spots. Instead of reacting to surprises, you begin to anticipate them, not because you predict perfectly, but because you see the underlying forces at work. When inflation rises, you expect bonds to behave differently than stocks. When interest rates fall, you anticipate how currencies might shift. This approach doesn't eliminate uncertainty, but it makes uncertainty manageable. Ultimately, macro perspective and correlation remind us that resilience comes from balance, not from bravado. By respecting the interconnected nature of markets, you avoid the illusion of safety in sameness and instead construct stability through diversity. By recognizing correlation, you see beyond the surface and understand the hidden ties that bind assets together. And by thinking at the system level, you prepare yourself to navigate both storms and calm seas with greater clarity. Understanding concepts is valuable, but the real test comes when those concepts are put into practice. Many people stop at the stage of learning definitions, theories, or strategies, but without bridging them to actual decisions, the knowledge remains abstract. In the world of finance, where words like shares and stocks carry precise meanings, the bridge between concept and practice can be the difference between clarity and confusion, between success and failure. Knowing what something is in theory is only the beginning. Knowing how to use that understanding in the messy reality of markets is where the true value lies. Take the distinction between shares and stocks. Conceptually, it's clear. Stock refers to the overall ownership in a company, while shares are the specific units that divide that ownership. But the bridge to practice lies in how you think and act as an investor. If you say you own stock, you might be speaking broadly about your exposure to equities. If you say you own shares, you're pinpointing a precise slice of a particular company. Translating this distinction into practice sharpens your ability to track portfolios, calculate returns, and understand risks. Without this bridge, the concept stays as theory, something remembered for an exam but not lived in daily investing. The same principle applies to larger financial ideas. Diversification, for example, is a well-known concept. Almost every investor has heard that spreading risk across multiple assets is important. But what does diversification mean in practice? If all you do is buy many different stocks in the same sector, you may believe you are diversified, but in reality, the assets are highly correlated. The concept of diversification only becomes effective when it is applied with nuance, mixing asset classes, balancing risk exposures, and considering macroeconomic forces. The bridge from concept to practice requires asking, how do I actually execute this idea in a portfolio that can withstand real-world conditions? Bridging concepts to practice also involves discipline. It is easy to talk about long-term investing, patience, and rational decision-making. The challenge is living those ideas when markets are volatile. In concept, the advice to stay invested through downturns sounds reasonable. In practice, it demands holding firm when prices are falling, fear dominates headlines, and everyone around you is panicking. That is where the true bridge is tested, whether theory can guide behavior under pressure. Without that bridge, even the best concepts collapse in the face of emotion. Another important aspect of this bridge is measurement. Concepts often live in words, while practice requires numbers. For instance, understanding that a share represents ownership is the concept. Calculating dividend yield, earnings per share, or return on equity is the practice. By measuring outcomes, you turn abstract ideas into concrete tools that inform decisions. Numbers make bridge real. They transform vague knowledge into actionable insight. There is also an element of humility in this bridging process. No concept, however elegant, survives contact with reality unchanged. Markets are dynamic, uncertain, and influenced by countless factors. Applying concepts in practice means adapting them, refining them, and sometimes learning through mistakes. An investor may start with the concept of value investing, buying assets below intrinsic worth. But in practice, they discover that estimating intrinsic worth is harder than it looks, and that patience is required to wait for the market to recognize value. The bridge here is not a one-time leap, but a continuous path of adjustment between idea and reality. Bridging concepts to practice also reveals gaps in understanding. Sometimes what looks clear in theory turns out to be more complex when applied. This is not a failure but an opportunity. It pushes you to deepen your learning, to go beyond memorized definitions and into real comprehension. Each gap encountered in practice sharpens your grasp of the concept itself, making the bridge stronger the next time you cross it. The importance of this bridge extends beyond finance. In every domain, whether it is leadership, health, or personal growth, people often know the right concept. Exercise is good, honesty builds trust, patience leads to better outcomes. The struggle lies in practice, in translating those ideas into consistent action. The bridge requires willpower, systems, and habits that anchor lofty ideas in daily life. Without it, knowledge is inert. With it, knowledge becomes power. Ultimately, the bridge between concept and practice is what separates passive learners from active participants. Concepts provide the map, but practice is the journey. Without walking the path, the map is just paper. By consciously building this bridge, testing ideas, applying them, refining them, you transform knowledge into wisdom, and wisdom is nothing more than concepts proven and lived in practice. So, as you step forward on your investing journey, remember, mastery begins with mastering words. Define your terms so they define your thinking. If you understand what a stock is and what a share is, you'll avoid confusion and invest with clarity. That clarity, anchored in good principles, will guide you wisely